Donald Trump has been in the Oval Office now for 80 days. There's so much going on in markets, but a couple key forces that are driving it. Here's what you need to know and consider for the quarter ahead. It's great to have your company for the weekly. Thank you for joining us this 11th day of April. So Donald Trump has been in the Oval Office for 80 days, and there's only been about 10 days since markets were pretty much disrupted by Liberation Day. And Donald Trump hit much of the world with tariffs. China then retaliated. Europe did too. And sure, Trump said he's open to negotiating, and he paused some tariffs on the world for 90 days. And he said he's open to negotiating. And then we saw the EU also paused tariffs as well. But while negotiations are underway and some pauses are in place, it means uncertainty is up in the air. That's the only certainty in town, uncertainty. But it means basically uncertainty for you and I for the things that we're going to pay in the future. The costs of goods remain up in the air. We don't really know what's happening. But this means the entire stock market and this quarter is looking pretty uncertain as well. That's the basics. So what is pressuring markets? What has a lot of people worried at the moment? Well, the market's fear gauge, we're looking at that and it's spiking. The market's fear gauge, which we track on Murmur by typing in VIX, V-I-X, earlier this week, it hit its highest level since the COVID-19 pandemic. It's fair to say markets are pretty worried. They're very volatile. I mean, yesterday, markets were up 12%. The next day, today, they're down 4%. So there's so many unknowns, as we say. So we need to remember a couple of things. First of all, remember the basics, that markets need direction to rally up because markets are forward-looking. Second of all, uncertainty is lingering while tariff uncertainty is up in the air. And remember, we don't know the direction of the economy. That's important because 70% of economic growth is obviously tied to the consumer in the US. That's where most of the economic growth comes from. Same for Australia as well. So this uncertainty is up in the air while interest rate uncertainty is also around. Now, the third thing that's causing uncertainty about is the direction of where companies are headed, what they're seeing for their earnings for the year ahead. Remember, the stock market is basically just a reflection of the health of the biggest companies in the world and also where they see earnings going for this year. Remember the basics, as we always say, earnings growth drives share price growth. And with tariffs, it makes it pretty bloody hard for a company to grow their earnings. But while pauses are in place, and by the by, tariffs are higher across the board, obviously that means profits are coming down. So there's a couple major things that you need to watch and consider ahead and be wary of. Perhaps we could group them into four key themes that are pressuring down shares. I want you to keep this in mind, but also, of course, pressure and fear bring opportunity, particularly if you do believe Morgan Stanley, who this week said there's immediate downside risks are looking limited. So that basically means we could see upside risk if you read between the lines. So what do you need to be aware of in terms of the downside risks? So the first one is to be mindful that a lot of companies are walking away from guidance. We saw that this week with Delta Airline, one of the first companies to report their earnings and outlooks in the S&P 500 companies that have so far reported this quarter. Delta, a bellwether for airlines, they said that Trump's tariffs are hurting bookings, and they're seeing a reduction already in their bookings and, of course, depressed broad consumer and corporate confidence. So that's why they've pulled away all growth plans for the year and they walked away from sales forecast for the year. Now, this is very representative of what we saw in COVID and it basically reflects what we could see from some of the world's biggest companies this quarter, walking away from sales forecasts for the year. Second of all, I want us all to be wary that companies are starting to abandon AI plans. Microsoft, let's think about that. Microsoft did this just days ago. So I'd be keen to keep an eye on their results. They come out on April 30. Now, Microsoft abandoned their $1 billion data center project in Ohio. Bill Gates and the CEO, Satya Nadella, made it pretty clear that it's hard to commit capital spending plans with tariff uncertainty. But the key point and the takeaway for you might be, when we've got one of the world's biggest companies saying that they're uncertain, we know this is not a very good sign for America's future. It's sort of also a very good sign for stock markets as well. And this basically, I think, really reflects the destructiveness of tariffs. And it makes you wonder, if it's so easy for a company that's the world's biggest company to walk away from AI and R&D plans. It just makes you wonder when job cuts might be, just like COVID-19. So think about this. If you are looking for long-term buying opportunities, Microsoft shares are now down 18% from their record all-time high. Remember, in the first trade war, just a reminder, Microsoft shares got as low as falling 18.5% from peak to trough before they then rebounded. So they've made a very similar pattern to what they have in the first trade war back in 2018. And back in 2018, we saw Microsoft shares fall about 19%, and then they rebounded 44% to a new record all-time high just after 1.8 months. So that's something for you to consider. But as I said, keep an eye on their results. They are out later this month, April 30. The third thing that I really want you to focus on and be mindful is that markets don't like even good surprises anymore, which is pretty outstanding. When you've got a company that sticks its feet in the ground and says, hey, we're sticking to our capital spending plans, like Amazon, the market doesn't like it. So Amazon said this week a couple key things. Number one, they're pushing ahead with their $20 billion US plan to get themselves into the space business. The company's CEO also defended their AI spending plans to fork out $100 billion US this year to develop AI. So really important to watch if they maintain this when they do release their results on April 30. And if you are interested in buying the dip in Amazon, strap in, it could be pretty bumpy. Just being mindful, Amazon shares, they're still in a bear market, down 24% from their record all-time high. But remember, in the first trade war, this company was hit pretty hard. Back in 2018, Amazon shares fell 36% from peak to trough. Obviously, Amazon is also a bellwether for consumer spending. So if consumers are hit pretty hard in this trade war, maybe we could see a similar pattern, more downside ahead for Amazon potentially before maybe expecting a rebound. But what about the rebound after they hit that new low in the first trade war? Well, I'm glad you asked. Let me tell you what that is. So in the first trade war, they fell 36%. But then they rebounded 55%. They hit a new all-time high after 4.5 months. So a very long recovery, I guess you could say, for Amazon. So just be mindful if you are buying the dip, if history repeats itself, expect a long, drawn-out recovery. Perhaps that reflects the pain of the consumer is the consumer is really hurting in an average trade war. Maybe that repeats. The other thing that I want you to be mindful of is expect companies to say that they may need to pass on higher costs and tariffs and maybe even cut costs and staff costs. So keep an eye on Apple. Apple, the biggest company in the world, report far later this earnings season, the 1st of May. Remember that Apple make 17% of their money from China, and please, please, please remember that most of Apple's costs are in Asia. So they are going to be hurt really hard if we do see further tariffs on China. Second of all, if we do see tariffs on chip makers come into play. We haven't yet seen that as yet. I don't know if you could include a Taiwan Taiwan in that, but I guess you could. But by the by, the market's still bracing for more tariffs upon Asia. But Apple shares are already down well in a bear market. They're down 26% from their record all-time high. In the first trade war, they fell almost 40%. So I'm just painting a picture that if you are buying into Apple, buying into the dip, expecting to make some money on the upside and hold for the long term. You might be expecting more dark days ahead based on the fact that we're bracing for tariff certainty, but also, of course, history never repeats itself, but it does rhyme. But when you are buying into quality companies, if you can call Apple a quality company, I believe they are. They're in a lot of quality ETFs around the world. Remember that Apple recovered after 6.4 months. That's a long recovery time, but they jumped 63% after the first trade war low. Across 6.5 months to a new record all-time high. I'm simply painting the picture that there are 4 key concerns pressuring down markets right now, but in opportunities and pullbacks, there's always opportunity to make money over the long term. It just depends what your strategy or thinking is when it comes to investing and trading. Thank you so much from everyone here at Moomoo. Stay safe. Have a wonderful weekend. See you on Monday.